Welcome back, investors. Yep, we are Ticker Time News, and I am Adam, getting it bumbled up right here at the start. Well, that's because I am so super excited. I'm tripping over my own words because it is official. Our Discord server is now live. Click the Discord link in the description below to come join us. We have set up a number of private and public channels. We want to make sure that this is for all investors, whether you're part of our Patreon and private investor club or not. So we've got it. And I'm just so excited that it's finally done. I have been wanting it to be done for months, and it finally is. Now, we tried to set up enough channels to keep topics organized within this crazy stock market without being so detailed that we have a bazillion channels. With that said, however, if there are channels that you would like to see on our Discord server, just drop a comment and we'll be glad to add them. Also, Patreon members, our private investor club. This is important. Let us know if the combination of private and public channels is the right choice. We'd like to have a space for all investors to enjoy, but also a space for our private investor community to thrive. So that's our goal. So let us know, again, your thoughts on the setup of our Discord server, because above all else, it was created for you. And on that note, watch out for our weekly top 10 momentum stocks list. We'll be releasing that this evening shortly after the live stream. Okay, what you're really here for, the stock market. The stock market opened today on a weaker note. I've got the SPX, which is the ticker symbol for the S&P 500 we use to track it. Now, I'm going to go to the 15-minute time frame here, and you can see on the right-hand side, not on the chart, but on the screen, there are these red numbers over here. This shows that the SPX was down 0.7%. The SPY was down 0.7%. The Qs were down 1%. The DIA, which tracks the Dow Jones, was down 0.6%. And the IWM, which tracks the smaller caps Russell 2000, was down 1% as well. And the dollar right now is pretty much flat. It's down 0.08% at the moment. So that's where we're sitting at today. So our indication from last Friday during our live stream, when I said I'm leaning towards Monday being a red day, well, it came true. And I wasn't sure it was going to. I thought we were on a path to being green today, but that all changed midday or early mid-afternoon. Now, here on the 15-minute time frame, you can see right here in the middle of the screen the big drop. That was Friday. And then today, you can see this gap down here, and then this rally that took place, starting somewhere around 11 a.m. Eastern time, and then reaching its high somewhere around 1:45 p.m. Eastern time. So looking at today's price action on a 15-minute time scale, it was kind of mute, right? It really didn't move all that much. Now, there was some pretty big selling into the close, so we have to take note of that. But the weaker opening and the selling pressure, you can see where it eased there mid-afternoon for the S&P 500, and it also did so for the Dow Jones. Both of them, by the which, briefly turned positive midday. And that's where I thought, well, maybe that call was off. The main indices all pulled back from the midday highs and closed with losses. Today's weakness was a carryover from Friday and a retreat from Friday, right? And that was fueled by Fed Chair Powell's comments that they're indicating that the Fed is steadfast about controlling inflation and may need to stay in a restrictive territory for a longer period of time. And that's something that we have been saying for months. The Fed will not pivot. I don't think the Fed's pivoting this year. I don't even think the Fed is going to pivot in the first quarter of next year. Maybe Q2 of next year, maybe, but that's still unlikely. Now, before diving into the dynamics of today's market, let's first start with the charts. I'm going to take a 1 hour view here. And the first place I'm going is the SPY, ticker symbol SPY. It tracks the S&P 500. You can follow along at home with all the charting we do. There is a link in the description to TradingView. Click on it, sign up, doesn't cost a penny, and you can chart right along with us. Now on the SPY, each candle represents 1 hour. We're on the 1 hour time frame. Now we are currently under a declining 5-day EMA, right? A 5-day moving average. It's the most frequently tagged moving average there is. Of course, it's a short-term moving average. However, it can give you short-term signals. That's why we use it. And it's starting to form a bear flag structure right now. So looking at this chart, let me pull it up just a little bit. I want to show you this a little more clearly. I'm going to grab our highlighter here, and you can see, right, we declined right here, okay, from last Friday. But here is where we're starting to make this bear flagging pattern, right? And what does this typically lead to? Well, this typically leads to more of a downturn, more down to come, right? Now, it's possible that we could slowly drift higher and then tag the declining 5-day EMA. This would still be a bearish structure. A move down would likely take us to fill the gap right around the lower end of this week's weekly expected move. And on the chart here, let me pull it up a little bit higher, you have these two purple lines, one at the top of the chart, right? And then one at the bottom of the chart. We got it here at the top, and we got here at the bottom. Now, there is a gap when we go to the daily view. There is a gap. It's right around $395. There's a small gap there. If the bear flag continues and we do head lower, watch for that gap to get filled, which would take us to the bottom leg of the weekly expected move. And that right now is 394.46. That's the bottom end of the weekly expected move. That's where the options market thinks the market could be by close of business on Friday within those two purple lines. Now, the options market is right 68% of the time. 1/3 of the time, it gets it wrong. Last week, it got it wrong, and that was because of the major selling and pullback that we had on Friday. Okay, so we've got this now for the SPY. 395. There's a gap there. Remember that number. If we can get above the declining 5-day EMA and, most importantly, hold above it, okay? So we would be looking for something above 405, right? If we could, in this bear flagging pattern here, or bearish, if we could get to the 405 line, okay, which is about right there, our high today, let's go back and look. Our high today was 405.83. If we can get above 405 and hold above 405, that would create a more bullish case for the SPY. So whether you're bearish or bullish, these are the key levels that you want to see. Bullish, 405, closing above it, holding above it. That's what you want. Bearish, you want to see this flagging pattern break down and fill the gap at 395, okay? But as of right now, the trend is bearish in the short term. All right, let's clean this map up here a little bit, and then I'm going to go to the Qs. Just a couple of clicks here, and we'll have it all cleaned up and ready for the next time. All right, going to the Qs. Again, down 1% today. And you can see a similar pattern here, but it's not as sloped upward as the SPY, okay? Let's pull this up here a little bit so we get the weekly expected moves here. We're still on the 1 hour time frame. So on the Qs, we have that same move. Boom. Expansion leads to contraction. So we had a big expanding move. Now we're starting to contract right here, okay? Now it's still making that very, very similar pattern that we saw on the SPY. It's just not sloping up as high, right? So it's more leveled out, but it is still slightly moving in the upwards direction. How's it going? Let's see here. When you have a chance, can you analyze the copper gold ratio? Absolutely. And that's a very important ratio to monitor too. That is a key sign of economic health, right? Dr. Copper. Copper is very important to our economy. So I will look into that. Let me just finish this thought here on the Qs, and then I just want to touch the IWM real quick, and then we'll get to copper and gold. Okay, the Q right now, again, in the same space, same pattern here as the SPY. Now, it is also tagging and holding above right now this dotted blue line that's coming across the screen. However, one thing to point out with this typical pattern, again, expansion leads to contraction, which leads to expansion. Now, the bottom end of the weekly expected move for the Qs is 296.86. The upper end is 318.02. That's your risk range right there. Again, that's where the options market thinks the Qs will close by the end of the day on Friday, between those 2 points. Right now, it is bearish in the short term. All right, let me just clean this up right quick. And I just want to point out one more thing, that dashed blue line there. I'm going to go to the daily chart to show you this. And it's one button here to clean it up. Okay, that blue dotted line, that has been significant in the summer rally. Why? Well, it starts here at the June 16th low for the QQQ, okay? And then it tagged it again July 1st. It tagged it again on July 13th, which was a Friday. Well, again, hold on. I don't know if it was a Friday. Excuse me on that one. Take it back. It also tagged it again on the 14th, the very next day. Those dates from the June low were support areas for the Q. And where did it stop today? That big move down on Friday, which is the big red candle, and then this little tiny candle, right? There's really no candle. It looks like a wick, and then there's just barely a little candle. It's like that. This is called a doji candle, right? Okay, it is sitting right on that dashed line there, which has been support since the June low. So that is a key area for the Qs. And that line right now is about where we closed at, all right? Somewhere between 304 and 305. I could firmly say 305 because it's a good, easy number to remember. So if the Qs can hold above 305, that would be a bullish sign. But again, in the short term, it is in a bearish structure, okay? But that level is key, 305. And again, it closed at 304.41, down 1% today. So again, there's a little zone, I guess you could call it, right? We want to see it bounce off of that. Otherwise, if it sinks below this dotted line, that's going to add a more bearish structure to it. AMD was a nasty short today. Semiconductors had it bad today. They did. They were some of the worst performing, at least at the bottom of the list. Okay, real quick here, I want to go to the IWM, then we'll do copper and gold right quick. IWM, again, that's small caps, like the Russell 2000. That's what it tracks. We've got the lower expected move at 182. Right now, the 50-day moving average is at 182. So just a few pennies off from where the 50-day moving average is right now. There's also a gap down there around or just above the bottom end of the weekly expected move. Now, I'm going to go to the 1 hour time frame again. And we can see here, we've got that same pattern right here. Expansion leads to contraction, which leads to expansion. Again, on the short term, it is a bearish setup right now, a bearish structure in the short term. The key level for the IWM to hold is basically where it's at right now. The low for today was 186. It closed at 187. That's basically where it needs to bounce from, okay? I thought we were going to get it because it started to bounce late morning, but then turned around early afternoon. Okay, copper to gold. First, let's go ahead and pull up copper. Now, I'm going to go to COPX, COPX, just real quick. We do a weekly expected move for this ETF, and this is the Copper Miners ETF right now. It's holding right here, just below its 50-day moving average. If I zoom in here a little bit, you can see that today's candle could not break above it, right? It was down 1.5% today. Friday is when it officially came down, closed below that 50-day moving average. Today, it tried to get up and reclaim it. It couldn't. And you can see last week, Thursday, my apologies. I messed up. I'm not even paying attention to my own charts. I thought I was on the daily. Okay, now let's get the accurate information here. Okay. Let me open it up a little bit. Same thing, just not on Friday. It happened today. We have the 5-day EMA, right? And that can tell us what's going to happen in the short term, at least the direction of where it's going in the short term. Friday, it came down, it closed above the 5-day EMA. Thursday, it bounced off of it. Wednesday, bounced off of it. Today, it closed under it, which short term puts it in a bearish perspective. It is above its 50-day moving average and bullish above, bearish below that 50-day moving average. That is important. Now I'm going to go to the 1 hour chart. Let me fix this real quick. Okay. Now it too has a very similar structure here, right? Expansion leads to contraction, leads to expansion, leads to contraction. In the short term, this is in a bearish structure, okay? Bearish structure. Now let me go over here. There is a tool. Let me see if I can find it real quick. There is a tool that I like to use here. I just have so many. Here we go. All right, it's loading. Let me pull this over here to our screen. Copper to gold ratio, okay? Let it load. It's almost there. Now, this is the chart showing you copper to gold ratio, right? When it's going down, we've got a weaker economy. When it's going up, a stronger economy. So you can kind of see the cycles that happen within this ratio, with it going up, holding, going down, back up, holding, going down, back up, holding, going down, right? And then it held down all through 2002, 2003, but then it went on a big run where the economy was growing there, and then it just falls. 2008, recovers at the beginning of 2009. So where are we now in this cycle? Well, we've peaked and we're heading back down. But one thing I want to point out on this is the bottom for this was July 18th. And from July 18th through to the last time this was recorded, which was August the 22nd, we've been in an uptrend, right? Meaning copper's value has been increasing. Gold has not in relation to copper, okay? Let's see here. Maybe this is related to building starts. You could combine those, and whenever you're doing technical analysis or you're looking at data to try to come up with a conclusion, it's always good to have multiple points of data to help either drive your point home or correct you and move you onto a different path. So yes, building starts can be combined with this to give you a better picture. And right now, looking at this, I'm just going to point out one thing here. Gold is the most widely recognized safe haven asset among investors. Therefore, during times of economic and geopolitical distress, it generally tends to perform well, making it a leading indicator of fear. Copper is the exact opposite. Because it is a key industrial metal that is used globally in a wide range of industrial applications, it performs strongly when the global economy is firing on all cylinders. This makes it a leading indicator of global economic health and has led to it being commonly called Dr. Copper. The ratio prices copper in gold and represents the number of ounces of gold it takes to buy an ounce of copper. That's what the indication is telling you when you're looking at the copper to gold ratio. Okay. So it is important, and it has been important. Right now, I think we have already reached our peak and we're heading lower. If we go on this chart here, this plateau, this top, it kind of started, we have it here, March 15th, 21. And if I go to about the end of it, it's about April of 2022. That's that kind of plateauing top that you see there on the chart. And then it head down pretty sharply. It did have a little bounce there, but I think I would compare that little bounce to maybe the peak that was hit here in 2019. We fell, then let me give you the month on that. April 2019, we fell sharply. September of 2019, we had a little rebound through November of 2019, and then it just fell off after that and hit its bottom on March of 2020. That's what I see happening here. We had a sharp decline. We got a little rebound, a little bounce, but then I think it's headed lower. Let me go back over here, and I want to pull up gold next. You can just type in gold. There's all kinds of them. GDX, that's one that we track the weekly expected move for, but I just want gold right now. Here we go. Gold this year has not performed as well as I thought it would. It started off strong, But as we go out and see here, oh, I'm on the 1 hour. Let's go to the daily. Still same decline, you'll see. Okay, here we go. All right, gold. I just want to look at this year and maybe December of last year. Okay, so we have December of last year to right now. Gold started to rally off of a support level in January of 22, this year, January. It peaked because of the war in Ukraine. With that starting, that sent gold skyrocketing. March 8th, 22, it reached its peak. It reached its peak of just over $2,000 an ounce. It's been declining ever since. Now, if I extend this top line trend line here, you can see that it did break it. Let's pull this thing all the way down now. Line it back up again. Okay. Since December, we'll go back here to the 1st of December. December 1st, $17.81 an ounce was the price. $17.81. If you bought gold on the 1st of December, you would be underwater right now. If you bought it and held it, you'd be underwater. But I think gold's fortunes are about to turn around. When the economy does poorly, copper goes down, but gold goes up. People want to preserve their wealth. And gold, over the eons, has been a good bet on preserving your wealth. Remember, when we're in a bear market, one of the best things that you can do is to preserve your wealth. It's the winner is the person who lost the least amount of money during a bear market or a recession or a depression, which is even worse than a recession. Here on the chart for gold, and then I'm going to look at the dollar because the dollar has been influencing gold this year. This decline, you can see with this black line, resistance back here in April of this year, resistance June of this year, resistance again June of this year. Resistance turned into support in August of this year. Now I think gold on the back half of this year is going to perform better than it has. We go to, and this transition of resistance to support occurred at the very beginning of August. We've got August 1st through August 4th is when the transition occurred. Gold popped up, it tapped out, but it came back to this line and found support. Again, on Friday, it was my apologies, today. The candle for tomorrow has already formed. Today, the candle is a doji candle, okay? It came down, it tagged this line, the wick of the candle did, but then the candle itself popped back up to close above it. So this held as support again today. These are good signs for gold. The negative that I would put in here, and I think it's going to cause a potential wedging for gold, is its 50-day moving average, okay? It's a blue line. It's been coming down, tracing the black trend line, but it ran like this, and I'll try to stay on it as much as possible here, okay? It ran like this, the 50-day. So gold slightly broke above it for maybe 2 days, August 12th, August 11th. It broke above that 50-day moving average, but then it fell back below. And it was resistance all the way down to it found that support on the black line, the black trend line. And now it's kind of being squeezed between that 50-day and the trend line. So something's going to have to give here. Either gold is going to break above the 50-day moving average, wherein Bullish above, bearish below. Bullish above will take effect. So I think gold will break above that 50-day. It will start outperforming copper in the copper to gold ratio. Will still decline. Because when we have slower economic growth, the world's not using as much copper. And that's what we're headed for. And Fed Chair Powell, he said it on Friday, expect pain for households and businesses. I don't know how you can interpret that line to mean anything other than a recession and pain for our economy. So, if our economy is doing poorly, copper does poorly, gold does better. All right, let me clean this chart up here just a little bit, and then let's talk about gold for just a moment. I see your question there, David. Now that there are more bogus dollars, how will that affect the price of gold in money? That's a really good question, David. Really good question. The dollar, excuse me. Let me pull up the dollar real quick, and then no, let me just do this. I want to stay right here real quick, and I'm going to the dollar. I said I was going to do that next, but let me just finish my thought here. Gold right now at 17.36 an ounce. There is a zone here that gold needs to stay between, okay? It really needs to stay above this declining trend line here. It needs to stay above that. That's number one. Number two, it really needs to start consolidating. It needs to start flagging or wedging or something, but it needs to start moving in this direction instead of moving down. That makes sense? Okay. So the price zone for gold to hold is 17.15 an ounce down to 1,700 an ounce. So really only a $15 spread there per ounce. That's the zone that gold needs to hold in my book. Because if we go back to December, this right here, this was at, let's see what the actual number was. The close was 17.25, and that's the low. Yep, 17.25 was the low there. So really, in all honesty, 17.25 should be the point that gold needs to hold above. I'm giving it a little bit of a chance here at 17.15 to 1,700. I think if gold can hold that zone, that would be a good buying opportunity for gold. 17.15 to 1,700, I think, is a good position to start with gold. Now, if it breaks down below that, set your stop loss at 1,700. Don't let it go below that. Because if it does, remember, more selling begets more selling begets more selling. We don't want to see that with gold right now. It's got to move sideways. Got to consolidate. We need gold to do that. And I think it will. Now, if gold can hold the 17.15 to 1,700 zone, then gold can go on a pretty nice run. And I think the target could be 1,900 right here to 2,000. I think that would be our target, right? We jump in at 1700. It holds, it consolidates, starts to move up as the recession deepens. And then we can let it run. Okay. So we'll watch gold. We'll watch it as it stays in this lower 1700 zone. But one thing that gold needs on its side is it needs the dollar to weaken. Here's the dollar, ticker symbol DXY, sometimes called the Dixie. Right now, the dollar itself is flagging. It's consolidating, okay? The dollar's been on a heck of a run here. And to your point about now that there's so much bogus money in the system, how will that affect the price of gold? Well, you can see here, this is what it has done to gold. As the dollar has strengthened, gold has decreased. I mean, look at this run that the dollar has been on. It's been bouncing off its 50-day moving average pretty successfully going back to February of this year for several months now. Okay, let me do this. Let's open it up a little bit right here. Take a closer look at what the dollar is doing. The dollar's been consolidating for about a week now. It is still holding above its 5-day EMA, which puts it in a short-term bullish bias, okay? Today, it bounced off of that 5-day EMA, but it may have produced a reversal candle. Now, a reversal candle, excuse me, let me get the highlighter. A reversal candle is one with, a wick like this, and the body of the candle is down on the bottom part of it, making like a sword. That's a reversal for a top, okay? In the opposite direction, you have your wick. Oh, that's a crooked wick. But the candle is up here on this side. That's a reversal off the bottom, okay? Just maybe a little bit too technical there on candle structure. But if that's the case, then as the dollar weakens, gold should strengthen. And the dollar has been on a big run right here. And you may say, well, the dollar going up like this, that's a good thing, right? Well, yes and no, right? There's always a plus and minus to everything. A strong dollar will hurt emerging economies. Okay. A strong dollar will hurt gold. Okay. A strong dollar will also hurt multinational companies. Think of Apple. It will hurt Apple. A strong dollar hurts Apple because their overseas money that they're making when they're selling in different currencies, when they go to convert it back to a dollar, they may lose. So that's a few things right there that the dollar does when it's strong. Weak, it will be the opposite of that, of all those effects. So I think the dollar could be making a topping pattern here. Although I don't have a crystal ball, the dollar could be consolidating right here. And if you're bullish and you want to see it go higher, 109 is what you want to see the dollar break. What did the dollar do today? Its high was 109.48. You want to see it break that 109, hold above the 109. That would be bullish for the dollar. Now, on the opposite end of that, if you want to see it bearish, it needs to break under this lower red line right here, okay? Break under that, close under it, and hold under it. That would be bearish for the dollar. And breaking under that line is breaking back down to 107. So that's what you would want to see here for the dollar. Okay, let's keep trucking. Back to the market here. What was the next thing here in my notes? Okay, the advanced decline line today in the market. I'll put the SPY back up here on the chart, and I'm gonna click one quick button to make it look better. Okay. The advanced decline line today favored decliners by roughly a 2-to-1 margin at both the New York Stock Exchange and the NASDAQ. The selling effort today brought down small caps, mid caps, and mega cap stocks all alike. It was a very broad-based selling effort. Now, the Russell 2000 closed down 0.9% or 1% if you round it, right? The S&P mid-cap 400 closed down 0.7%. Then we have the Vanguard Mega Cap Growth ETF that I love to track, ticker symbol MGK. It closed down 1% today. And we started doing weekly expected moves for this ETF. And I have the numbers here for you right now. The bottom end for the weekly expected move is 189.43. The upper end is 212.02. That's the weekly expected move for the Vanguard Mega Cap Growth ETF. If you want to play that one. Because mega caps are great leaders for where the market is heading. They are directional leaders. If they're moving up, the market's moving up. If they're moving down, the market's moving down. Obviously, that's oversimplified, but right now, it's under its 5-day EMA. Short-term, bearish structure. It bounced on its 50-day simple moving average, which is bullish. So we've got some counter arguments here that could be made on the strength or weakness of mega caps using those two indicators alone. Moving averages, I guess you should say. Okay, with this closing down 1% today, if you look at the Invesco S&P 500 equal weight ETF, ticker symbol is RSP. We do weekly expected moves for this one too. I don't have them on the chart today because I don't want to give out all the weekly expected moves. I usually hold out to Wednesday, so that way our investor community on Patreon, they get them Sunday evening and they can have a few days of advanced numbers to play with. Okay. With the equal weight, it was down 0.6% versus the 1% for mega caps. Now, it's also below its 5-day EMA. It has not reached its 50-day moving average yet. So it could have more room to go. Also, there was no discrimination between value stocks and growth stocks today. The Russell 3000 Value Index closed down 0.9%, while the Russell 3000 Value Index closed down 0.5%. Not a big swing there. Then we come to semiconductors. Ticker symbol SMH. We do weekly expected moves for them. I see your question there. Please elaborate on how you arrived at that range. Okay. There's an equation that you use using options market data to arrive at the weekly expected moves. They are risk ranges for the options market. What you do is for a particular stock, ETF, indice, whatever it may be, you pull up the end of day, the closing number on a Friday. Let's use SMH here, the Van Erickson or Van Erik Semiconductor ETF, ticker symbol SMH. To get the weekly expected move, you go to the options chain data. First, you get the closing number from Friday. Then the equation, you open up the options chain, you find the in the money number, you take that number, you add it to the second in the money number on the call side. Then you go to the put side and you take the in the money number, you add it to the lower in the money number, and now you've got four numbers that you've just added together. And again, you're one other thing for the equation, you're also using the next expiration date for the options chain for these specific numbers. Add them together, divide it by 2, and that's a very rough estimate on how to arrive at weekly expected moves. That's a rough estimate. That will get you pretty darn close. Okay. Now, that's almost the exact formula that we use. A few more calculations in there, but that will give you a very easy number to get to. If you want to do your own research on weekly expected moves for other stocks or ETFs or whatever the case may be. Because right now we're doing about 40 products. We release them every Sunday evening, and they're good for the upcoming week. And the next Sunday, we do another 40 products. I want to extend that. We do all the major indices, the SPY, the Qs, DIA for Dow, IWM for the Russell. We do all 11 S&P 500 sectors. We do a lot of subsectors like semiconductors here. We do individual stocks like your mega cap stocks. Those are the 40 products that we do weekly expected moves on right now. That is awesome. They usually work great. That is true. And the reason they usually work great is because the options market is pricing this risk range or risk ratio in for the upcoming week. And the options market is correct on this range 68% of the time. So for SMH right here, there is a 68% chance. Okay. I don't know how good my numbers can be here. Let's give that a go. There's a 6. And let's see if we might get something that looks like an 8. There is a 68%. Let's do this. A 68% win rate. That by the end of the week, by the close of the end of the week, SMH here will be within these two lines. So just about 2/3 of the time, the options market is correct. 1/3 of the time, the option market gets it wrong. Like last week is the perfect example of that 1/3. Because of the big sell-off on Monday, that put the indices in sectors and almost all the products that we do weekly expected moves for at the bottom end of the weekly expected move. So there wasn't really anywhere else to go. So the big sell-off on Friday took almost all the products below the lower end of the weekly expected move. That's the 1/3 time it gets it wrong. But it's nearly 2/3 of the time it gets it right. And I would rather go with a equation that is right 68% of the time, because that's as close to a, don't want to call it a guarantee, but that's a pretty darn good win rate, especially in a choppy, unpredictable market like we're in right now. That's why I like to use, let me change that, not like, I love to use, and I do use in my daily routine, weekly expected moves. That's how important they are. If a stock, an equity, or ETF, whatever the case may be, semiconductors here, for example, if they were to go outside the bottom end of this weekly expected move and say Wednesday they're down here, 68% of the time, by Friday they're back up in this range right here someplace. I would much rather go long when it's down here, set my stop loss just a little bit under that, and then by Friday be back up here, making a nice gain from that move. I know there's all kinds of wiggly green lines there. It makes it hard to understand. I hope that you're following along with those. And then the opposite is true. If, for example, Tuesday, it's broken out to the upside, using other indicators, of course, not just solely weekly expected moves, but take a short position right here. And then by Friday, it being back right here within the weekly expected move. I'd win 68% of the time if I followed a strategy like that. But of course, you want to use other indicators to go along. You never just want to use one indicator by itself to judge where you should go in the market, especially right now. This is one of the most difficult markets to navigate right now. But again, that 68% win rate, that is pretty incredible. All right, semiconductors. Okay, semiconductors, here we go. They sold off more sharply today. They are under their 5-day EMA. They are under their 50-day moving average. This is looking pretty bearish and looking pretty weak. The Van Erik Semiconductor ETF closed down 1.9% today. Bottom right-hand corner, you can see that, to 118.54. The weakness here helped to bury the information technology sector by 1.3% today, placing it at the bottom of today's leaderboard for the 11 S&P 500 sectors. You can see them here on the right-hand side of the chart. There's only two greens, the VIX and energy. So, my apologies. There are three greens. I'm sorry, utilities. I missed you there. Utilities were up 0.3% and energy up 1.5%. And then, of course, volatility, the VIX, it was up 2.5% to 26.2. That thing keeps racketing up higher. We are going into a phase of more volatility ahead. So watch out for swings up and down. Now, energy, let's go to energy here. Excuse me. It got its boost today by rising oil prices. Excuse me for a quick second here. All right, a little Gatorade to shake it up. The energy sector here. I've got the weekly expected moves for energy. And let me just give you a little visualization here. Energy's been on a run lately, leaving a lot of gaps. in the price action. Right now, from where it closed today, and again, up 1.5%, risk is growing, your reward is shrinking, according to the options market. The bottom end of the weekly expected move is 79.3. The upper end is 86.3. From where it closed today, you can see with the green and red boxes here, your risk is growing, your reward is shrinking. Now, this big move that energy's been on here, a lot of gaps, like I said. So this could be on shaky footing right here. I'm hoping that energy starts to contract right here and consolidate. If you notice, energy has really just been on expansion mode, and there's hardly any contraction anywhere. I mean, just going, sure, we could probably say that maybe this area right here was contraction, but then expansion, expansion, expansion. And of course, my marker didn't work there. Expansion, right? Expansion, 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 expansion. Where's the contraction? The market usually has a cycle of expansion, contraction, expansion, contraction. Expansion leads to contraction, contraction leads to expansion. The market's got to digest the information it gets. That's when things start to consolidate before it makes its next move higher or lower based on the data it got, on where it thinks things are going to be in the future. So this type of movement is not sustainable. You need contraction somewhere along the line. All right, let me clean this up a little bit, and then we will go and look at oil. Just type in US oil on TradingView. Easy ticker to remember. That takes you to WTI crude oil. I'll pull this up here a little bit so we can see for sure the numbers. So it's at 96.7 right now. Crude oil futures closed 1.4% higher to $96 a barrel today. And you can see on the chart, oil has made a bit of a reversal here. Let's pull this up a little bit. You can see oil had a big downtrend line here, but that trend down, let's see if I can't extend this down, keep everything lined up. It made its reversal down here on August 16th when it broke below this green zone right here, this green bar, and many people thought, oh, oil's done. Oil's going lower now. It's over, folks. No, oil decided, nope, we're going to creep back up. Now, on the chart here, there's a very important line. It's this yellow line running across the screen like this. This is the 200-day moving average. And then we had a declining 50-day moving average, but they are converging right now on oil. And if we zoom in a little more closely at those two lines, let's open this up some here, and you can see there is a bit. There we go. Hopefully that's a little bit better. Today, Friday, oil broke above the 200-day moving average, closed above it. Today, that was support for oil. The 50-day moving average acted as resistance on Friday and resistance today. So oil is being squeezed right now, and it's going to expand one way or another with these two converging moving averages. If we look at the RSI, it's at a 58, 80 and above, or 70 and above. That's your overbought. We're nowhere near 70. So there's still room for this to rise. If we look at the MACD, it's moving up steadily. Even today, there was more momentum added. So this is important here. And then it has this trend line. Since it reversed, it's moving up like this. Let me keep it in line here, right there. So if oil comes back to tag this and bounces off of that, maybe it moves sideways and contracts here for a few days and then hits it. That can be the break above the 50-day moving average that it needs, and then it's going higher. And I think because of the trouble in Europe right now, with the fuel shortages this winter, they could be at record highs. And what is that going to do to oil? That is not going to cause the price of oil to fall. When you have the lack of something and you have the demand for it, the price of that said object expands upward. So I am not in the camp that thinks oil is done, that oil hit its limit and it's going to start to contract, to decline, to fall. I think this winter is going to be especially key on what happens. Okay? If we have fuel shortages here in the US, that'll just add to the problem. And right now, the future outlook, it's not very rosy. I know there are some out there, many out there, who are in the opposite camp that I am, thinking that the economy is just on pause right now. It's about to explode and go higher and go faster and go stronger. I'm not so sure. I'm not in that camp. It's okay if you are. That's good. Different ideas coming together, that works best. Let's see here. Wouldn't natural gas be more bullish with the Russian pipeline closures? I don't know about more bullish, but definitely in the bullish camp. Europe is going to have it rough. And if oil prices get too high that people can't pay for it, then the government will probably step in, subsidize it, causing the price to go up even more. And that's for all of your energy products, not just oil. So we've got to watch energy. Right now in the US, I do not see a plan of transition from oil to electric. I do not see a plan whatsoever for transition. It's like in the US right now, the government wants to snap their finger and go from a petrodollar to a electric dollar. I don't know. Electric? I don't know what you would call the electric version of the petroleum petrodollar. Maybe you guys know. But yeah. Now, oil today, why did it go up, causing energy to go up? There was a Bloomberg report today that indicated the nuclear talks with Iran have been extended for a few weeks because there was some disagreement on key issues. Now, whether you agree or disagree on that or not, that's going to affect the price of energy as well. Okay. The bond market. Many are looking to the bond market as the wiser choice in the markets. There's more money in the bond market. It's a big deal. I don't want to run off to treasuries until we're done with energy here. Some oil, gas products have to be burned to create electricity. Solar and nuclear are small. Great point. Great point. Right now, and this is my problem with petroleum and clean energy and the debate between them. Give me a plan to move towards clean energy, solar, wind, if you want to throw it in there. Well, I don't think wind is one of the best ones. I personally think nuclear is the best clean energy option. Small, compact nuclear plants, micro nuclear plants, I think is the best idea for clean energy. But right now, again, like I have said a few times already, there is no transitional plan in place, in public view from the government saying, here's the step-by-step way that we're going to do it. No, there isn't one. Again, the government, I think, from what I can see, wants to snap their fingers, wave their magic wand, and say, hey, we've made it. You can't do that. It doesn't work that way. Okay. I do think solar has a place. I do. Small nuclear facilities, I think, is the best option. So there's a place for clean energy. Wind, I'm not too crazy about it because, it takes petroleum to build those windmills. I mean, it takes petroleum to build almost anything. So I definitely get your point, David, there on how much petroleum it takes to create electricity through different means of production. Absolutely. Okay, the treasury market. It's typically seen as smart money, wise money. Okay. The 2-year yield, it rose 2 basis points today. US 02Y will take you there on TradingView. It rose 2 basis points to 3.42%. It's up a little bit in the after hours. You can see our red line there on the chart. That was a point of resistance that it has broken through over the past week, and it just continues to march a little bit higher. It too is holding above its 5-day EMA, which puts it into a short-term bullish bias. We want to see this one come down, and we want to see the 10-year go up a little bit. But the 2-year right now is being heavily affected by the economy. The 10-year today, it rose 8 basis points. So there was a little bit of a narrowing of the inverted yield, not by much. 5 or 6 basis points. That's not a whole lot when it's really in the hole. Looking at the 10-year, US 10Y for the 10-year. Again, it rose 8 basis points to 3.11%, and it's sitting there right now. This one is also in a bullish bias structure above that 5-day EMA. It's been rising above it. When it pulled back last week, it tagged it and used it as support and bounced and continued off of it. Let's look at TLT. We do a weekly expected move for TLT as well. TLT is the ticker symbol for the iShares 20 plus year Treasury bond ETF. Okay. The weekly expected moves you see here are not the updated ones. Again, I won't put those out here until Wednesday to give our investor community time to have the numbers first. That's what I think is fair. It has been rising here for the past few days. And I think this could be a good source moving forward. I think you could probably start thinking long term here on TLT. Is there some investment vehicle that we can put our money into or put our money in to get that yield? Banks are still paying 0. What are those bars on the left side of your graph? Okay. I think TLT is a good source, a good place to get into for bond yields rising, I think. Now, if you are looking for an investment vehicle to precisely go into, say, a 2-year note, then okay. Just remember that banks will go about it a little bit different than, say, an investment firm. Of course, the investment side of the bank will also go at it a little bit different. But the way banks make money, and don't forget this, it's a crucial part, they borrow on the short term and they lend to the long term. So when the 2-year goes up and it's inverted to the 10-year, then the banks are basically being squeezed. So banks don't like that inverted yield. Now, specific investment vehicles, because this is YouTube here, I cannot specifically talk about, because technically this is entertainment this is for entertainment. So I just want to be clear about that, and I want to keep that boundary there clear. Definitely don't want to get in trouble with the government, for sure. TLT here, I think, is a good choice. Right now, if we scroll down here on the right-hand side, you can see that the dividend yield here is 2.07% at the moment with TLT. If you're looking for a low volatility, high dividend, there are those accounts out there. It's different than bonds or treasuries. Okay. We actually did a weekly expected move this week for one of them. Oh, oh my goodness. Now I've done forgot. Oh, I've done forgot it. Let me go real quick over here and pull it up. Give me one quick second, just opening up that weekly expected moves. Oh, it's right on the tip of my tongue. I know it starts with an S. S something. SDHD, or what is it? All right, it's loading. Give me a quick second here. SPHD. SPHD. That's right. right? Yeah, SPHD. Okay. I'll leave you open for a moment in case we need you again. Okay, here we go. This is the Invesco S&P 500 High Dividend Low Volatility ETF. Did a weekly expected move for this one this week. I am in this one. I do hold it. I just want to make sure that I'm clear about that. And I haven't forgot your question about what's on the left side of the graph here on the chart. So this is technically a ETF product that is supposed to move a lot slower than the actual market. It's got a 3.7% dividend yield right now. It was down 0.3% today versus the S&P 500 being down more than that. Okay. Sometimes, yeah, it doesn't move as hard as the broader market, S&P 500 specifically, because that's what it is akin to. On Friday, it was down 2.3%. And then if we go to SPX to track the S&P 500, that was down 3.3% also. Let's put that SPHD ticker back up here on the screen real quick. I don't have the weekly expected moves drawn out here on the chart, but I do want to say we did do the weekly expected moves for this. It did hold its 50-day moving average. That's bullish, but it is now under its 200-day, under its 5-day moving averages. So that's not strong. It's weak. But it is holding a trend line here that it is now slightly under, but it did hold at its 50-day. And again, this moved 0.3% when the broader market moved 0.7%. So this is one of those options. It's okay. It's not the greatest, to be honest, but it's okay. Now, on the left side of the chart here, it's difficult to see. They're a bit faded, but there are these bars over here, okay? Right over here, just like this. What they're showing you is the volume, just like on the bottom down here. This is showing you the volume on the day for that very specific product you're looking at. But instead of just volume for the day for all trades, on the left-hand side here, this is a volume shelf profile, and it's showing you the volume per price point. Okay, so there was more volume for the SPHD ticker, high dividend, low volatility. The highest volume here for price point is right around this area that it's in right now. As a matter of fact, the highest point is right here at 45.31. That's where the majority of trades occurred. So this is really, really helpful to show you the different price points that people are buying at, right? And when it was higher, there was the second point is up here, and it's right around this resistance area right here, which is right around 47.5 per share. Okay, so the volume shelf profile over here, it's an indication of the volume per price point, which can be very helpful. To give you an example of how helpful it can be, let me clean this up just a little bit here. When you see areas like this, where you have a high point on the bar graph here and another high point, and then you have this dip in volume where there's not a lot of volume coming in at, that's telling you that at that price range, there's not a whole heck of a lot of support. So that can open you up to seeing this move right here, a gap down, right? It's technically called not technically, but I call it an air gap in between those two high points of volume. So the, kind of like the C shape right there, I call that an air gap, where there's not a lot of people stepping in to purchase at that price point or sell at that price point. So the green is the buying, the orange is the selling. In the middle right here with the highest volume, and then of course you have it falling off here with the green and red bars off to the top and the bottom of where the majority of pricing takes place. So the majority of trading happens here, okay, and then up here. And that can be real good to help. That can be real helpful when you're trading to know that information. And it's in the indicator section on TradingView. Real easy to add to your chart. Very customizable. So that's what those lines are there on the side. And then it will tell you also when you put your cursor over a specific bar, it'll tell you what the trade amount was. So for the biggest spike at the 45.3 mark, there was 1.2 million buying, 1.6 million selling, for a total of 2.7 million. That's what it's telling you. So more selling happening at this point, and that's really indicative of, the gaps here and the big fall on Friday. Okay. Any other questions? Let me know. I think I've reached the end of my notes here. So if you have other questions, keep them coming. Let me just say here real quick that do me a favor and click that like button. Also, subscribe if you're new, and share this video with a friend. Those things are very helpful for a small channel like this. And of course, if you like this perspective, if you want more of it, click the first link in the description. A lot of valuable, I think, valuable information, weekly expected moves for 40 plus products. We want to add more. We're slowly building that out. We're also working on another interesting service that gives you the daily expected move, like I guess we could call it that. We're still working and tweaking that out. We share it every once in a while. Top 10 stocks and 4 different categories. Like shortly after this video, we'll be sharing with our investor community the top 10 momentum stocks for this week. We also do top 10 stocks for dividend stocks, value stocks, and growth stocks, and a whole bunch of other information. It's information that I myself use, and I figured, you know what? why not just start a YouTube channel, share the information that I myself am using to help others learn, to help myself learn, and why not build a community off of it? I think that would be great, be wonderful. And that's our goal. And it's all for you. I guess one thing left here on my notes, and then we'll wrap it up here. Tomorrow, okay? Tomorrow, we get the June FHFA Housing Price Index. The prior reading was 1.4%. We get the S&P Case-Shiller Home Price Index. The expectation is 19%. The reading last time was 20.5%. And those come out at 9 a.m. Eastern. And then the August Consumer Confidence, the expectation is 97.4. The prior reading was 95.7. So expectation on consumer confidence has dropped. Has risen, but only slightly. And I think that's mainly due, like we saw with the Michigan Consumer Sentiment Report, due to oil, gas prices coming down a little bit. But now they're starting to tick back up some. So we'll see how that holds. But the more important thing at tomorrow is the July JOLTS, which is the job openings. The last reading was 10.698 million job openings, which came down from the bigger 11 plus million job openings. So if that keeps dropping, Jerome Powell last Friday said there's going to be some softening in the labor market. And we'll look at JOLTS tomorrow and see how it is. And just one last thing to note, in case there's any questions about it. There was no real economic data of note today, nothing major. So again, tomorrow, just watch for those key levels that we talked about. This is a tough market to trade in right now, and you do not want to short in the hole. I know it's tempting when the market is going down to want to short, to want to go in an inverse ETF or ETN. It's very tempting to do so, but now's not the right time. Let me just give you a quick example here on the SPY. If you wanted to use an inverse S&P 500 SPXS to short the S&P 500, you don't want to do it in the hole. And what I mean by that is we've already come down, right? Quite a bit. So shorting now is you either get lucky or you're going to lose out. You want to wait. Patience is key in a choppy market. So with the SPY, again, you want to watch really that 395 area. If the 395 area, if it's broke, then you might have an opportunity for shorting. The 50-day moving average is right here too. As a matter of fact, it's at 399.28 right now. If you were to short right now at 402 and it goes to 399 and then bounces off that 50-day moving average, you're going to lose. So don't short in the hole. Now, on the flip side of that, if it, does bounce off of that 50-day moving average right here, then you want to see it start to break above today's high, and today's high was 405. So breaking above that 405 level, that would be a key sign that maybe we're going to bounce and go a little higher from here. Okay. Now, on the short-term basis, like I showed you today, we are in a bearish setup for the short term right now. So do be careful, be patient, and click the first link in the description to join our investor community. Or better yet, and I need to add this now, the second link in the description is to our Discord. It is now open. There are public channels, there are private channels. Come join us. All right, ladies and gentlemen, thank you so very much for joining me today. I greatly appreciate your time. Thank you for the questions. I greatly appreciate them. I'm here every day the market closes to go over what happened, why it happened, and what to expect, but most importantly, to answer your questions. Okay, I'll see you tomorrow. And for our investor community, I'll see you later tonight with the top 10 momentum stocks for this week. Take care.